Hi everyone, this channel is about something different. I want to break down the deep intersections of global affairs, philosophical wisdom, and the art of investment from a sober Eastern perspective. Because of certain professional constraints, I can only appear as a digital avatar, but I promise the geopolitical and financial analysis I provide here will offer value far beyond the surface. If you want to stay ahead of the curve and receive my full-length articles every week, please subscribe to my Substack. It's currently free. Just search for @Hotbone on Substack or check the link in the first comment. Now, let's get into it. The dollar index is climbing, and everyone tells you it's because the U.S. economy is strong or because the Fed might hike rates again. Well, don't let that number fool you. Look at the reality. The dollar is rising, but U.S. equities are falling, and treasuries are crashing. In just a few weeks, the 10-year yield surged from 3.9% to 4.3%. This isn't a signal of confidence, it's a signal of escape. Capital isn't buying dollars because it wants to, it's buying dollars because it needs to liquidate positions, hedge, and get out. The real breakdown is happening in offshore dollar liquidity. Money is fleeing the Gulf states, and some institutions are openly saying they will never return to the Middle East. They are selling everything, converting it to dollars, and moving it to Singapore, Hong Kong, or even into Bitcoin to simply disappear. Think about the end of April. That is the critical deadline. If the Middle East doesn't settle down by then, and the Bank of Japan hikes rates as expected, the global yen carry trade will start to snap back. Layer on top of that a U.S. economy where Q4 GDP was just revised down from 1.4% to a measly 0.66%. Consumer spending is flat, but inflation is stuck above 3%. To be honest, hiking rates into this kind of stagflation would be suicide for the U.S. economy. Besides, a rate hike can't reopen a blockaded Strait of Hormuz. That's a physical constraint, not a monetary one. There's a dangerous triangle forming between oil, the dollar, and equities. Since 2022, the U.S. has become a high-tech version of Russia, earning from chips, oil, and grain all at once. But to keep the stock market rally alive, the government has to weaken the dollar. The problem is, they can't do that unless they flood the market with oil from the Middle East or Russia to kill the price. Meanwhile, the U.S. private credit market has hit $1 trillion. These funds used to have solid cash flows from software and tech, but AI is starting to disrupt those business models. We are already seeing the cracks. BlackRock is facing redemption pressure where they can only pay out about half of what investors are asking for. If private credit blows up, it hits the pension funds, and the Fed will have to step in to rescue the system yet again. So how should you position yourself? Right now, cash is the most underrated asset. It's not about being a pessimist. It's about waiting for the signals to clear by the end of April. If the Middle East, Japan, and private credit risks all hit at once, you want to be the one holding liquidity when everyone else is trapped. Interestingly, the hello trade logic for Chinese assets is starting to play out. Because China has the full industrial chain and lower energy costs compared to its neighbors, its exports are actually becoming more competitive in this high-cost environment. The markets operate on one big assumption, that the Fed will always save the day. For 20 years, that's been true. But what happens the day people start to doubt the rescue itself? For the full breakdown in my weekly investment frameworks, make sure to follow me on Substack. Just search @Hotbone or click the link in the comments. It's free to join, and it's the best way to get this analysis delivered straight to you. I'll see you in the next one.